cutting small savings rates and increasing the frequency of reviewing the rate to quarterly from annually is expected to streamline the transmission of monetary policy rates by banks. But bankers say they may not have scope to cut rates too much too soon. CNBC TV 18's Alexander Mathew tells you why.
The government has paved the way for banks to toe the RBI's line when it comes to rate cuts. It has cut interest rates on small savings schemes, which bankers say compete with bank deposits. So should we expect banks to now cut rates further? Not really, say the bankers.
Rate cuts by the government was long overdue. The banks have already cut the rates for over a year and a half now. And as we have been commenting and mentioning, further cuts would have been a bit difficult with the government rates being pretty high.
However, some experts disagree. They believe banks will move faster to pass on lower rates to customers, especially when taken in conjunction with the new formula to calculate base rates that comes into effect from April. They argue that banks also have enough headroom to lower rates since the 125 basis point rate cuts announced by the RBI in 2015 were not fully passed on to consumers. But again, SBI's MD Kannan says it will take time.
I would say in 3 to 6 months' time, in stages, in different buckets, depending on how it is. But you must have also noticed that there is a general tightness in the liquidity in the market. Therefore, I think they may not be in a hurry to release the rates. But if the government starts spending and then there is adequate liquidity in the system, that would be a case for lowering of the rates.
Nevertheless, there is some hope that if the RBI, in its April monetary policy review, cuts rates by at least 25 basis points, banks may get a further nudge. But of course, all such effort will be limited by the need to put away cash to provide for the cleanup of bad loans. In Mumbai, Alexander Mathew.